You know what is genuinely, profoundly infuriating? I am talking about the kind of frustration that keeps you awake at 2 in the morning, staring at the ceiling. It is spending weeks of your life reading through complex financial filings, carefully balancing your risk parity, diligently allocating your hard-earned capital into a diversified index fund, and then logging onto the internet only to watch a guy who literally eats crayons for breakfast flex a 200% return on a coin named after a dog. It is the modern tragedy of high beta markets, and quite frankly, it makes responsible retail investors feel like they are completely losing their absolute minds. Honestly, participating in the financial system today is exactly like going on a Tinder date with a guy who aggressively calls himself a visionary entrepreneur, but 45 minutes and 2 ridiculously expensive cocktails into the date, it turns out he actually just sells solar panels door to door. And somehow, to add maximum insult to injury, this guy is currently richer than you. Watching the United States government manage its spending right now is exactly the same vibe. It closely resembles a guy going through a massive midlife crisis, just maxing out 6 different credit cards on sports cars and desperately praying the bill never actually comes due. Welcome to the high beta delusion. Today, I'm going to break down the secret Dunning-Kruger market cycle, and I promise you by the end of this incredibly deep dive, I will completely prove that everything the mainstream financial media is telling you about investing right now is undeniably mathematically wrong. We are going to uncover exactly why the absolute dumbest, most irrational trading strategies are dominating the market right now, and the terrifying, inevitable reason why they only work until gravity returns to Wall Street. But before we dive into the complex math and the terrifying frameworks of why your responsible portfolio is getting outperformed by literal internet jokes, we have to step back and look at the foundational history of how we actually got here. If you want to understand the current madness, you cannot just look at today's charts. Let's rewind the tape. We have to go back to the 2008 financial crisis. Let's really set the stage for what happened because it completely changed the DNA of global capitalism. Back then, the entire global banking system was on the brink of total collapse. It was a terrifying moment where the gears of the economy essentially froze. Central banks around the world, completely panicked, realized they only had one play left in the playbook. Their solution was to drop interest rates to absolute zero and print trillions upon trillions of dollars. They effectively flooded the basement with cheap money to put out a fire. Now, at the time, that might have saved the foundation of the house. But that massive, unprecedented flood of liquidity created an unintended, monstrous side effect. It trained an entire generation of investors to just blindly buy the dip without ever looking at a balance sheet. For an extended 17-year bull market, we have lived in an upside-down reality where bad economic news actually became good news for stocks. Think about how insane that is for a second. Unemployment ticks up, the market rallies. Factory output drops, the market hits all-time highs. Why? Because bad news meant the central banks would just turn the money printer back on to save everybody. If you look closely, this situation is eerily similar to Japan's lost decades in the 1990s, where the artificial propping up of zombie companies warped the entire economic reality of an entire nation. A zombie company is a business that does not even make enough profit to pay the interest on its debts, but it survives strictly because borrowing money is virtually free. But there is a massive difference between us and Japan. Instead of facing the quiet, deflationary stagnation that Japan experienced, our markets reacted with a weaponized, debt-fueled euphoria. And that brings us to the terrifying under-the-surface turn. If you turn on traditional financial media today, and you all know exactly which networks I'm talking about, you will hear a constant, deafening narrative that the economy looks great, the consumer is strong, and the stock market is simply unstoppable. But they are quietly ignoring the complex, systemic financial issues brewing underneath. Why? Because unpacking the hidden mechanics of finance and macroeconomics requires actual nuance. And nuance absolutely does not generate easy clicks. They don't want to bore their viewers with reality. They don't want to talk about the massive private credit boom. For those who don't know, private credit is basically a massive shadow banking system where regular companies borrow trillions of dollars directly from Wall Street funds at floating high interest rates because traditional banks have cut them off. It is an unregulated ticking bomb. They also don't want to talk about the terrifying underlying data showing that everyday Americans are absolutely drowning in systemic debt, maxing out credit cards just to afford basic groceries, while the stock market paints a picture of infinite prosperity. Instead of addressing these deeply concerning realities, we are looking at a fundamentally broken system built entirely on retail euphoria that has quietly but completely detached from actual fundamental valuations. Right now, in this very moment, you have broccoli-haired teenagers in Discord servers acting like literal financial savants just because they YOLO'd their life savings into a meme coin right before the latest GTA 6 trailer. They are completely insulated from reality, listening to David Goggins' podcast while they day trade, and they genuinely, with zero irony, believe they have outsmarted a century of financial theory. And the most terrifying part of all of this? The market is currently rewarding them. Let's really peel the onion on why this irrationality is winning right now. We are currently trapped in what I call the Dunning-Kruger market cycle. In psychology, Dunning-Kruger is a well-documented cognitive bias where people with low ability drastically overestimate their competence. In the financial world, it is what happens when someone confuses a wildly speculative 17-year money-printing bull run with their own personal, unparalleled investing genius. They think they are Warren Buffett, but they are actually just riding a wave of artificial liquidity. These pseudo-investors are entirely reliant on the greater fool theory. This is a mathematical and psychological framework proving that you can buy an overvalued, fundamentally worthless asset like a JPEG of a monkey or a completely speculative crypto token and still make a massive profit. How is that possible? Because the intrinsic value of the asset does not matter. The only thing that matters is that there is a greater fool willing to buy it from you at an even higher price later. It's a brilliant scam, and I can prove it. It's the exact reason why Bitcoin and meme stocks behave the way they do. You are not buying a company with cash flow. You are buying a psychological game of hot potato. You are betting that the guy behind you is slightly more irrational than you are. This dynamic is the very core of the high beta delusion. I know beta sounds boring Wall Street jargon, so let me act as your investigative truth teller and translate it for the everyday retail investor. Beta is simply a measurement of how volatile an asset is compared to the broader market. If the S&P 500 moves 1% and your stock moves 3%, that is a high beta asset. When the financial system is overflowing with cheap debt and stimulus checks, high beta assets, which are usually the most speculative, highly volatile, fundamentally garbage investments, will naturally outperform everything else in the short term. The dumbest investors are beating you right now simply because they are taking on astronomical levels of risk without even realizing what risk actually is. They think they are playing a sophisticated game of chess, but they are actually just pulling the lever on a slot machine that happens to be rigged to pay out temporarily. But do not mistake this for just a retail phenomenon. The problem goes way beyond college kids playing hot potato on their phones. On an institutional level, the exact same reckless behavior is happening, and traditional media is completely ignoring massive global risks like the cross-currency carry trade. Let me explain this because it is vital to understanding why the whole system is currently a fragile house of cards. The cross-currency carry trade is a highly complex maneuver where massive hedge funds and institutional banks borrow billions of dollars in countries with zero interest rates, like Japan, just to pump all of that borrowed money into high-yield, high-risk American assets. They're literally taking out free loans across the globe to gamble on Wall Street. It works brilliantly, right up until the moment those foreign interest rates tick up or the currency fluctuates, and suddenly the most powerful institutions in the world are forced into massive margin calls, unwinding trillions of dollars of leverage overnight. And this is exactly where the terrifying mathematical framework of gambler's ruin comes into play, especially for these reckless prop trading operations and over-leveraged crypto bros. Gambler's ruin is a statistical certainty. It is a mathematical proof that shows if you play a game with extreme risk long enough, your probability of eventually hitting zero is exactly 100%. Let me break down the numbers to make this digestible. If you are playing it safe and you lose 10% of your portfolio, you need an 11% gain to get back to even. That is manageable. But if you lose 90% of your portfolio on a highly leveraged, irrational meme trade because you thought you were invincible, you do not need a 90% gain to get back to even. You need a massive 900% gain just to recover your initial capital. These high beta traders are effectively flipping coins on train tracks, waiting for a massive systemic debt crisis to completely wipe them out. Eventually, this high beta delusion is going to completely shatter. There is a fundamental law of financial physics. You cannot outrun a bad balance sheet forever. When liquidity inevitably dries up, and it absolutely will, and gravity finally returns to Wall Street, the market will abruptly stop rewarding these irrational, crayon-eating gamblers. The deeply unsexy foundational realities like actual cash flow, systemic debt burdens, and genuine fundamental valuations will suddenly matter again. We aren't just going to see a simple temporary market correction where the S&P dips 10% and bounces back next month. We are going to witness a macroeconomic wealth transfer that will define an entire generation. The return to fundamentals is going to be incredibly painful for the people who think stocks only go up, who treat the stock market like a 24/7 casino fueled by Discord hype. But for the contrarian investor who actually understands the data, who looks at the history of market crashes, and who refuses to buy into the mainstream media's shallow optimism, it will be the opportunity of a lifetime. So instead of just summarizing everything we've talked about today, I want to zoom out and look at the bigger societal picture, and I want to ask you a real question. Are we currently at the absolute peak of this Dunning-Kruger cycle, or is there still room for one last crazy, irrational run before the final crash completely resets the board? Drop your take in the comments below, and I'll see you in the next one.